Well, good morning, traders. Never a dull moment in the markets. And this weekend, I actually became a grandfather. So a couple of interesting things happened, really, not only in the markets, but overall. So let's have a look at what's happened. There's been some news about Silvergate and Silicon Valley Bank in big trouble. Fed may be bailing them out. There's a Fed meeting today. There's panic. Everyone thinks there's a run on the banks. The Fed are going to start cutting rates, etc., etc. I don't think it's going to be like that. But nevertheless, we'll have a look at what happens if the Fed does start cutting rates. I don't think they're going to. In fact, I'm pretty sure they're not going to. But let's think about it in any case. And I've put a comment up on Twitter which pertains to that. All of that aside, let's have a look at the technicals on the charts and ignore the fundamentals for the moment. We've got a lot of news coming up this weekend, so we'll talk about that as the week goes on, particularly within my discussion group. But the dollar index has now dropped down into the sort of pocket, really, the more or less the 50% retracement of the move upwards. We've gone into that colored zone. We're at the 50-day moving average. We formed another little spike low. I did put a tweet up and a little video on the weekend about what I think might happen here, and we saw this spike low down below support. We saw something similar on the 10th of August last year when the interest rate announcements were made. I think that pattern still holds. We've just moved down to the 50-day moving average into the center of this support area, bounced up from there a little bit today, and with a bit of luck the dollar index will hold, and we'll begin to fill this gap above us, which was formed over the weekend due to the potential unfolding bank crisis. We'll see what happens, and the Fed's intervention and basically backing up and bailing out the banks if need be. We've seen the dollar just sort of moving down a wee bit, gapping down, forming a little gap above us and finding support at the 50-day moving average and bouncing back up again. My idea for long trades on dollar still exists. That hasn't changed. For those of you wondering if we're now going to be short the dollar, long the pound and the euro and everything else, that's not my position at the moment. This is a good support area. There's the 50-day moving average, previous support going back this way into late last year. And it really forms the basis of this sort of, don't really want to say it, but it's a sort of a nipple-shaped bottom, breast-shaped bottom. Sorry, children. Potentially a move back up from here, up into my target area, which remains 106 and then 107.50. What that means is that we expect the euro and the pound to move lower. The euro has just moved up into resistance, into that purple zone above us, and where the 50-day moving averages. It's interesting that the euro and the dollar index are both meeting up with their 50-day moving averages at the same time. With a bit of luck, we'll find resistance here. It's a good resistance level. It's a left-hand side of a potential head and shoulders pattern going back to late last year, similar to the dollar index, but upside down. So we'll wait and see. We're short on the euro. Same with the pound. It's moved up into resistance. There's also the 50-day moving average where we are at the moment, and previous resistance level, that red line going back some time, and more recently as well. It's a good resistance level. If we're going to go with the idea that the dollar index will continue to find strength and rally, then the pound and the euro should follow suit. Remember, folks, these are just ideas. These are my concepts at the moment. They can change. And they will change if we find that the chart patterns change and that we begin to rally up through resistance firmly on the euro and the pound and the dollar index drops below support. We'll have to change our ideas, and that's the nature of trading. We're going to have a look at the yen pairs. We were short CAD yen and Australian dollar yen last week, and we made good profits on both of them. Right now, on the Australian dollar yen, after having taken profits, we're going to be looking to resell this on a rally back up towards these moving averages, that green horizontal resistance line, and towards the underside of this upward sloping channel line. If you zoom out, you can see overall we've still got this crowning pattern in place and nothing has changed, and we expect this to move down eventually to 87 or 85 in that region there, and then over time we want to complete this pattern and see the Australian dollar yen move down into towards the 80 level, thereabouts. Same applies to the dollar yen. We're looking to sell the dollar yen up into rallies. I have been in a short hedged position on US dollar yen up until now, and I exited that trade last night actually at the opening of the market right at the bottom here for a reasonable profit. It was hedged, so I didn't get all of it, but I got a good chunk of it. And now we're looking for dollar yen to perhaps bounce back up a bit as the dollar index begins to rally potentially, and we could see dollar yen moving up into this pink zone and perhaps up into this blue zone, somewhere up around between 138 and 142 before looking to sell the dollar yen again. The only other trade on the yen pairs that's of interest is CAD yen, which we did sell last week, and we made a good profit on that. And now we're looking to sell CAD yen. I think the CAD yen pair will be the weakest of the three that we're looking at. Of course, there's euro yen, which we haven't really looked at yet, but I think CAD yen will be the weakest of the three, considering that the Canadians were the first to halt their interest rate hikes. And so we're probably going to see some weakness in CAD against other currencies. And we're now short CAD yen again, up against this 50-day moving average. It's interesting that so many currency pairs are batting up against the 50-day moving averages. Gold's a tricky one because with the idea that banks might be failing and people are potentially moving into gold as a safe haven, and with this renewed idea that the Fed may somehow pivot because of these bank problems, there's going to be a move into gold, or a strong sentiment in favor of gold. And we did see gold gap up over the weekend, but it's only gapped up into the 50% retracement of this move down. Potentially gold has still got some downside in it, down to below 1800. It's difficult to sell gold right now, considering the sentiment, and I think it's probably worth just holding on and waiting for it. For those who are aggressive and who believe that this short idea on gold down to 1800, 1780, maybe 1750 or 40 before a bounce and a continued rally, if that's your idea, if you have that idea in mind, it might be a good time to sell gold now. I'm slightly tempted, and I might look at it later on the day if we perhaps move up to, let's say, 1900, maybe another little rally on gold up to the 61.8% fib for a move down from there, back down to 1800 and below. But we'll have to see. I think it's a little bit risky considering the sentiment brought about by these banks failing and the Fed potentially bailing them out. So we'll leave gold alone for now. When it comes to NASDAQ and S&P, well, this is going to be a real mixed bag, a real mess. We've got interest rate considerations. We've got market considerations. We've got banks potentially failing left, right, and center. We've got the housing crisis potentially on the horizon. I don't think it's going to be like 2008. I don't think that the US will allow this to happen again so soon after it's already just happened in 2008. But you never know. Depending on what goes on with housing and the Fed bailing out banks and what they've got to say, there's a meeting going on today. Depending on all of that, it's going to affect how the stock market reacts. I think it's completely chaotic. I really don't know, to be honest. Normally, I've got a good sense of direction on NASDAQ and S&P, but as it stands right now, I think there's equal potential for us to rally up to new highs this year or for us to start falling dramatically. And I think we're going to have to go with momentum on these, and I don't know which way that momentum is going to play out. So we'll just have to wait and see. And for now, no trades, but let's see what happens. I'll give you some trade ideas on S&P, for example. If we rally up to the underside of this channel line, up to perhaps 39.80, somewhere around, maybe 4,000, we might have a go at selling S&P. If we get a rally back up there, back up to these two moving averages that are curling down at the top, and at this Fibonacci level and the channel line bottom, might be a good place to sell. Or we might look to buy S&P on a dip down to maybe 3,800, maybe slightly below that, maybe 37.60 or 37.50. Right now, I think we're just in the middle. The market's waiting to see what's going to happen. You can see if you kind of take this as an overall range, with the top being up here at around 41.20 and the bottom being around 37.50, 60, 3,800. We're kind of right in the middle of that range. We're beneath the moving averages and the bottom channel line, but we're above the support levels, so real mixed bag. And if you take that as a guidance for NASDAQ, we'll see the same sort of thing, kind of in the middle, just bouncing around. There's the overall range. You can see the bigger picture, 12,600 and 11,600, roughly in that range. We're slap bang in the middle. Look where the moving averages are. We're below the 20, above the 50 and the 200, above the 100, but touching the 50 and the 200, right in the middle of these two support and resistance lines, moving sideways across the page. No high probability trades going on right now on either NASDAQ or S&P. If you're trading stocks, you might want to look at individual stocks, something that I generally don't do most of the time. One interesting move over the weekend was Bitcoin. Surprisingly, with all that news, Bitcoin actually rallied, but we've moved up to the underside of these two moving averages, the 20 and the 50. We have broken above this downward trend line. It's a very short-term one, so it doesn't have a great deal of relevance, but we've also rallied to the underside of this horizontal support line, which goes back some time into last year. So once again, we're pushing up against the upper bounds of the range. We may fail here. It's not a good idea to be buying at the top, probably better to be selling And if anything, I would be looking to sell Bitcoin. But having said that, the rally over the weekend was impressive. Selling into a really strong rally is also not a good idea. I don't know. I think I'd stay away from Bitcoin. Natural gas, I did a video on Saturday on natural gas. That view still holds. Nothing's changed. I'll put a link up to that video at the end of this one. Please go and have a look at that if you're trading natural gas, and I'll update as we go along there. There's really nothing to add to that video on natural gas at the moment. Before I go, I did put up a tweet on Twitter. Go and have a look at that. An interesting observation about 2008 and the Fed cutting rates after the 2008 financial crisis and what happened to the dollar index. As the Fed fund rates went down, the dollar index actually rallied. That's something to bear in mind. Keep that in mind when you're thinking about the effect of these bank problems and the potentially looming housing crisis on the dollar index. Actually, when this all went down in 2008, it was positive for the dollar. So go and check that out on Twitter. So if you're not following us on Twitter or on this YouTube channel, go across to Twitter. The handle is ArcisFX and you can follow us there. And if you enjoyed this video, please like it and subscribe to this channel. Take care.